to the Options Academy. In this presentation, we'll discuss naked options. As always, to maximize your learning experience, you can refer to our written article which matches this presentation. Before we start, however, I would like to quote an anonymous trader who was asked about trading naked options and replied, "When the ocean is sleeping, everyone is a great sailor." What it means to you is when you think about naked options, you should proceed with great caution. Selling naked options means selling options without buying or selling the underlying market or other options for protection. It's often said by many traders that selling naked options in terms of risks stands alone at the top of the pyramid. While selling naked options is not a strategy we usually promote, we do take the view that any strategy has its time and place. We also propose that an extremely speculative position, like a naked option, if managed correctly, may result in less risk to a portfolio than a position which is more conservative in its nature and being managed poorly. With that said, I would like to stress that naked options are inherently riskier than credit spreads or calendar spreads because spreads essentially carry limited risk, while naked options offer unlimited risk potential. Let's take a look at an example in which the S&P 500 is trading at the 1300 level. For whatever reasons you may have, you are anticipating the market to trend down in the coming months and you want to sell a naked option. You would therefore be selling a call option. By selling a call option, you will be bringing premium into your account. Should the market trend down, as you predict, the option you sold will expire worthless and you will keep the premium you collected. In fact, if you are wrong about your prediction and the market stays flat, the option you sold will also expire worthless, and actually, even if the market slowly trends up but does not reach your strike price at expiration, the option will expire worthless, making the trade a winning trade. All in all, the farther out of the money you sell, the less premium you collect, but the probability for a win is higher. The closer to the money you sell, the more premium you take in, and at the same time, it is more probable that the market will reach your strike price. So you decide to sell a call option. There are several ways you could approach this. You can be selling an out-of-the-money call. Selling a far out-of-the-money call means you would be selling a call that is well above the 1300 level. Strike prices such as 1350, 1400, 1450, and so on. How much is well above? That is really up to the trader. Some traders use statistical analysis. They look at the history of the market and calculate what an average monthly move in the last 10, 20, or 30 years. Once they have determined what the number is, 7%, 10%, 15%, etc., they would sell the call at a level that is higher than that average. For example, a trader who wants to sell a call 11% out of the money would sell the 1440 or the 1450 naked call. 1300 times 11% equals 143. 1300 plus 143 equals 1443. And you should note that we did not suggest the 1443 strike price. That's because the S&P options are offered at a minimum of 5-point intervals, 30, 35, 40, 45, and so on. Also note that we did not choose the 1445, which would be the closest choice. We skipped the 1445 because the 10-point intervals, 10, 20, 30, and the quarterly intervals, 25, 50, 75, are much more liquid. Other traders look at highs and lows in order to determine a strike price to sell. For example, if the recent monthly high for the stock index was 1375, they would sell at 1380, or the 1400 strike price. Both of the methods above are popular ways of choosing a level in which to sell an option. We think both give you a decent advantage over trading the underlying. The advantage is manifested in the fact that both methods give you a great margin for error. Think about it. If you shorted the market using the underlying market and it went up, you would immediately start losing. By selling the 1380 call option or the 1440 call option, you give yourself 80 points or even 140 points, respectively, room to be wrong about the direction of the market. Let's look at numbers. Let's take a look at a 1375 call strike price on the S&P 500 to find out how you could win and how you could lose if the market goes against you. Seeing how you can win is easy. Ultimately, at the end of the day, if the market trades below $13.75 at the date of expiration, the call option you sold will expire worthless, which will mean to you that you get to keep the premium you collected. So again, to see how you win, if the market expiration is trading anywhere lower than $13.75, and assuming you held the position to its expiration date, the option will expire worthless, and you can make a check mark next to your winning trades Excel sheet. If, however, at expiration the market is above $13.75, say $13.80, you are responsible for the difference between $13.75 and the point of expiration, minus the premium you collected. Take a look, and if this is going too quick for you, you can refer to our written article titled Selling Naked Options, which contains the same information. If you sold a $13.75 call and collected 4 points or $1,000, each S&P point is $250, and the market expired at $13.80, you are responsible for 5 points minus the 4 you collected, which leaves you with a 1-point loss or $250. Following the same calculation, if the market expires at $13.90, your loss would be $27.50. The difference between your strike price and the market at expiration is $13.90 minus $13.75 equals 15. The amount you are responsible for minus the premium you collect is 15 minus 4 equals 11. The total points you are responsible for multiplied by $250 is 11 times 250 equals $27.50. Let's look at another example in which the market at expiration is hanging at the $14.25 level. This scenario will yield the following results. The difference between your strike price and the market at expiration is $14.25 minus $13.75 equals 50. The amount you are responsible for minus the premium you collected is 50 minus 4 equals 46. The total points you are responsible for multiplied by $250 is 46 times 250 equals 11,500. So by selling a call option far out of the money, you are collecting a relatively small premium for the privilege of having a large margin for error. As you just learned, a strong and persisting market move may turn an out-of-the-money naked position to an expensive one. Nevertheless, if your affection to naked positions has not yet been reduced, and your conviction of a directional market move is strong, there's another way you could bite into the cake using naked options. You can be selling an at-the-money call. Selling a call option at the money. Maybe you read some news and listened to a few bearish experts, or maybe it's raining outside. Be what it may, if your conviction of a coming drop in the market is growing stronger, you could sell a naked option at the money, at the current market level of 1300. When you sell an option at the money rather than far out of the money, you are collecting a much greater premium. If you are right and the market heads nose down, your profit will be substantially higher. At-the-money options carry the most time value premium when compared to all other options. This is because while the option is at the market level, and therefore has the greatest probability of expiring in the money, its premium is comprised of time value alone and no intrinsic value at all. Let's talk about what happens before expiration. When selling naked options, it's important to remember that the greatest advantage of option sellers is being non-directional. While there is always some consideration to market trends or a large move, you don't have to be completely right about the direction of the market in order to win. If you sell an option and the market moves against your prediction, but in a slow and moderate manner, the option you sold may still expire worthless. On the other hand, it's extremely important to remember that naked options do carry unlimited risk. As you can see from the example above, if the market does trend against your presumed call position, your losses may be significant. But there is another part to the naked option story, which you should consider very carefully when comparing naked options to other strategies, and that part is called staying power. If you noticed in the prior segments, I mentioned the expiration date, and I also said if you held your position until expiration, this is a very important point to understand. It's true that if at the date of expiration the market has fallen short of reaching the level in which an option was sold, the option will expire worthless. However, many option traders tend to give too little attention to the process that takes place between point A, selling the option, and point B, expiration. The fact is that between these 2 points, the market rarely stays at the same level. It might move favorably to your position, or it might move adversely to your position. One thing is certain, the market will move. If the market moves favorably to your position, then all is well. But if the market moves against you, since naked positions have no built-in mechanisms to mitigate losses, the losses may be striking. A few factors will then come into play. Those are losses, psychology, and staying power. The psychology of a trader plays a great deal in the decision he or she makes. Hope, greed, fear, emotions, discipline are all part of the puzzle. There are numerous different kinds of traders, some conservative and some aggressive, some with deep pockets and a lot of hope, and some with less funds and more discipline. Of all the traders, only a handful are able to look straight at the eyes of the abyss, which is unlimited loss, and not blink first. Having limited risk built into your position helps you look straight by providing you with staying power. Alas, when trading naked options, a large adverse move against a position more often than not causes traders to close their naked position for a loss, only to watch the market turn around and watch their option eventually expiring worthless. Maybe one of the most important aspects most option traders overlook when charting their trading plan is maintenance requirements and its effects. For those of you who trade stocks, it's important to understand that in the futures options world, margin is not a loan you are taking from your broker or your clearinghouse. The use of the term margin is an unfortunate and confusing choice of words. Margin is simply the minimum amount you are required to have in your account in order to support a position. It is a collateral bond. In any case, the margin requirement will fluctuate daily, corresponding to the underlying market moves and to how much risk a position carries. The fact is that regardless of the quality of the position or the distance of the market from the strike price, many traders are pressured to liquidate positions at a loss because of high margin requirements. This happens simply because the naked option carries unlimited risk potential and is lacking any component to mitigate the risk if the adverse move continues. To illustrate the requirement differences between a naked option and a spread, which is a limited risk structure, you could look at this general example. The margin requirement on a naked S&P option could range from approximately 12,000 in times of low volatility to well over 20,000 in times of high volatility. The margin on a 30-point or 50-point spread limited risk strategy is approximately 1,500 to 4,000. That is significantly lower and has a significant effect on your trading. Having limited risk built into your position helps greatly reduce your margin again and again, providing you staying power when the markets move against your position. Another aspect of lower margin is the return on margin. Think about it. If you sold one naked option in order to collect $2,500 and your margin is $17,000, your return on margin may be a little short of 15%. $2,500 to $17,000 equals 14.7. If, on the other hand, you sold 3 spreads to bring in $2,500 and your margin on the 3 is $5,400, 1,800 times 3 equals 5,400. Your return on margin would then be over 46%. 2,500 to 5,400 equals 46.3%. Not only you get to sleep better at night, but your return on margin on winning trades is greater. With this note, we will conclude this segment about the basics of naked option selling and move along to the next 2 naked option strategies, the strangle and the straddle. Not before reminding you again that while selling naked options might have its advantages and time under the sun, we usually recommend trading with built-in limited risk. Here is to your success, and remember, there is substantial risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results, and remember that only risk capital should be used. Hope to see you again soon.